In today's video, I am going to talk about price to earnings ratio, the definition, interpretation and application. So the agenda for today's short video will be what is price to earnings ratio, the interpretation of P ratio, PEG ratio, which takes into account the growth along with P ratio, and then application of P ratio and PEG ratio. Let's start with what is price to earnings ratio. So P ratio tells us how expensive or cheap a stock is. It compares the price of a stock to the profit per share earned by that company. In simpler words, how much investors are willing to pay for rupee 1 of company earnings. Formula for P is price of one share divided by earnings per share per year. At aggregate level, it can also be calculated as market capitalization of that company divided by total earnings of that company. Now both numerator and denominator have the same units. It could be rupees or USD. So P ratio has no unit. It's a simple number. However, there is another way to interpret price to earnings ratio. Here the earnings per share has a time dimension as well. When we say earnings per share, it is usually earnings per share per year. Now if you take that into account, the unit of P ratio becomes number of years, and that is the interpretation I'm going to explain. So P ratio has a unit, that is number of years. The way it can be interpreted in this manner is P ratio tells us how many years will it take to recoup the investment, assuming the current rate of earnings per share remains constant. For example, if price of a share is rupees 200 and its earnings per share per year is rupees 10, then P ratio is 20, 200 divided by 10. Now how to interpret this 20? This implies that it may take you 20 years if you pay 200 rupees and earn 10 rupees per year. You'll have to wait for 20 years to get your initial investment back. If a company has PE of 1, it is considered as a bargain or a value buy because you will recoup your investment in just 1 year, and thereafter whatever earnings per year you have, it will be your profits in subsequent years. On the other hand, if a company has PE of 100, it is considered very expensive or overvalued because you will have to wait for 100 years to get your initial investment back, which means you are never going to get your initial investment back in your lifetime. Now, is this the correct or complete interpretation, or are we missing something? So the key part here is the assumption which I highlighted earlier in red, which is it takes into account the current rate of earnings per share at a constant rate. Now if you want to focus on growth in earnings per share year on year, you will have to consider PEG ratio, which takes into account the growth of earnings per share per year. So let's discuss PEG ratio. PEG ratio takes into consideration the EPS may not be static but growing year on year. So the formula for PEG ratio is P ratio divided by growth of earnings per share in percentage. Less than 1 value of PEG ratio is considered that the share is undervalued. The stock may be undervalued because P ratio is lower than its earnings growth rate. If PEG ratio is equal to 1, it is considered to be at fair value because the market value is considered in line with its expected growth. And lastly, if PEG ratio is more than 1, the stock is considered to be overvalued because the price is high relative to expected growth, earnings growth. Now another simplified version we are considering here is that this growth rate is assumed to be constant. We are not considering the growth rate itself changing over years. So PEG ratio gives you a more realistic picture of how long it will take to recover your initial investment. Let's see one application of PE ratio and PEG ratio. If we take last year's EPS to calculate P ratio, it is called as trailing P ratio because we are considering last year's earnings. If we use next year's estimated earnings per share to calculate P ratio, it is called as a forward P ratio. Now consider that the stock price is at 100 rupees and the last year's EPS was 10. So the trailing PE ratio will be 10. If we assume 100% growth in EPS, the next year's EPS, that is current year's EPS, will be rupees 20. In that case, for the same stock price of 100, the forward P ratio will be 5. 100 divided by 20. In the subsequent year, if we assume the same rate of growth for earnings, EPS will be 40 and P ratio will be 2.5. And in the subsequent year, EPS will be 80 and P ratio will be 1.25, assuming the stock price remains at 100. So if you consider the cumulative effect of the EPS, it would be 150 rupees. That is 1.5 times of the original price that you paid of 100, and this will be in just 4 years. Now consider the trailing P ratio. Without considering growth, based on last year's earnings per share, the P was calculated at 10, which means it would have taken you 10 years to recoup your investment. But with considering the growth aspect, now you are going to recoup your investment very early. In fact, you are going to get 1.5 times of your original investment back in just 4 years. Thus, the other interpretation of high P could be that it is expected to be a high growth company and the future growth is already factored in the current price. When a company is expected to show very high growth of earnings, the PE ratio expands and the stock price further increases continuously. On the other hand, when growth collapses, the PE ratio will shrink drastically and the stock price will crash till PE ratio falls down to a level which reflects muted growth in future earnings. Here is one example of Tesla. Now Tesla's P ratio was 34.8 in 2022 and it was growing rapidly. It grew, the P ratio grew to 100 in 2024. As of today, that is in 2026, Tesla's trailing P ratio is between 366 and 379, whereas its forward P ratio is 192, which reflects the rapid expected growth in future earnings. Now Tesla's P ratio has been highly volatile in last 10 years. So it was ranging from as low as 31 to over 1200, which indicates Tesla is in its growth phase and the expectation of EPS growth is very high and it is already built into the price. In India, we have similar companies such as Eternal, which used to be Zomato earlier, Adani Total Gas, Avenue Supermarts, which runs DMart stores, Nykaa, and so on, who have very high PE ratios. Now, this could be interpreted as either overvalued or the companies which are promising high earnings growth in coming years. Similarly, there are companies such as Coal India, ONGC, GAIL, REC and so on, which have very low P. So one interpretation could be these companies are undervalued or they are not going to grow as much in coming years. So you can further analyze PG ratio for all the companies for high P and low P ratio, and see if their valuations are justified when you take into account the expected growth in earnings per share. Lastly, P ratio is actually inverse of earnings yield. So let's see how it maps to earnings yield. Suppose you own an apartment valued at rupees 1 crore. So you buy that apartment for 1 crore and then you rent it out and you get a rent of rupees 8 lakhs per year. So your earnings yield, that is E by P ratio, is 8 divided by 100, which is 8%. So you can say that your earnings yield on this investment is 8%. Now this is nothing but inverse of P ratio. So in other words, P ratio of this investment into an apartment is 100 divided by 8, which is equal to 12.5 years. In other words, if you purchase an apartment for rupees 1 CR and if you are going to get a rent of 8 lakhs per year, you will have to wait for 12.5 years to recoup your investment. So in this way, you can compare an investment in an apartment with a stock return to see what is the best alternate investment option. So this was it for P ratio and PEG ratio. Thank you for watching this video. I'll come back soon with another concept explaining another term in finance. Thank you.